Michael, the U.S. surprised with a 50 basis point rate cut. Why now?
Well, first off, it's quite a remarkable feat. The last time there was an intermeeting cut was 2008, so certainly not a great precedent when you think back in time. I think part of this was really about confidence. I think the markets had really moved rapidly. We had the largest, fastest 10% sell-off in history, and the Fed was stepping in and trying to buoy confidence within financial markets because there is much more uncertainty today than there was a week ago.
And how's the market been reacting initially to this emergency rate cut?
So yesterday, stock markets rallied about 4.5% in the U.S., and I believe that was likely on the expectation of policy action. So today, stock markets are up marginally, 0.5%. Bond markets are rallying anywhere from $1 or so, give or take. And so there has been a pretty big reaction in the financial markets, although I would argue that the reaction's been more on the fixed income side and not so much the equity side.
And we haven't seen rate cuts, as you mentioned, a 50 basis points rate cut since the 2008 financial crisis. What does this say about the economy?
Well, there's a few things to take away. This is going to lead to a pretty fast slowdown. And you should be expecting a technical recession is not outside the question. Our expectations are it will be sharp but short, and that you would likely see a sharp rally or rebound afterwards. But if you think about what's being affected right now, travel, consumption, tourism, all those industries are seeing rapid declines because people aren't moving, and therefore you are going to see some pain on the economic side in the couple quarters to come.
And do you expect to see other central banks moving to cut rates to follow the Fed?
Yeah, absolutely. So Bank of Canada is up tomorrow. I would expect a 50 basis point cut now, quite frankly. The Royal Bank of Australia cut last night. And I would expect you'll see more and more monetary policy action coming in the days to come.
We're going to continue to get updates about the coronavirus from the CDC, from the WHO. What are some of the things that you're watching?
Yeah, so on the virus front, we certainly watch the rate of new infections and looking for an acceleration or deceleration. Certainly the hot spots right now would be certainly Italy and South Korea, where you're still seeing some degree of acceleration of infections. But in China, the epicenter of the virus, new infections are now down 80%. So we were running, a week ago at over 500 a day. Now we're into the 100s a day. So the Chinese have been able to stem the flow of this. And that's, I think, in many ways why why the World Health Organization has been reluctant to call this a pandemic, meaning it's uncontrollable and you're just trying to manage it. I think we're still in the stage where once we are able to figure out where there's a cluster of infections, they're able to take action and not have it spread rapidly.
So given everything that happened, what do you tell anxious investors who are concerned about their portfolios?
Yeah, we've been speaking with a lot of clients in the last week. Certainly there's a lot of angst out there. A few things. One, firstly, markets discount the future. They don't, while we all focus on the front page, markets do look out into the future. And if I think about where we're at today, while the distribution is pretty wide, my sense is that in 12 months' time, this will be for sure yesterday's news. That when we look at our estimates for kind of 5 and 10-year returns, because there has been a sell-off, as a result of that, we believe that the longer-term expectations for returns are now actually higher. And so for investors who are trying to build wealth and are looking at that like longer-term view, now is certainly the time to be considering investing, because while it might be uncomfortable for a week or so, the biggest threat to an individual investor is not actually having enough capital there when they need it. And I'm thinking more 5, 10, 20 years out, not next month.
So have a long-term view.
Always.
Certainly. Michael, thank you very much for your insights.
It's been a pleasure.